Joining us from Newport Beach, California, we have Tony Crescenzi, who's a market strategist and portfolio manager at PIMCO. Tony, thank you so much for making time for us. I know you're up early each and every day.
Thank you for having me.
What do you think about the sell-off? What do you make of this current market environment here?
Well, there was a thesis in the first half of the year that the second half would be a lot different for the U.S. economy and maybe globally. The thesis rested on the idea that, in particular, the waning influence of government stimulus and inventory investment would weaken economies. Now, economic data of late have come in weaker, so the thesis is being tested, and many are believing in it, especially now, if we think in the United States, many states begin their fiscal year on July 1st. Of course, that's this week. And in the focus on that, many are seeing that these states are cutting back, that they have to engage in austerity. So government at every level is having to cut back on spending at a time when economies are still fragile, and we haven't yet seen economies reach the self-reinforcing mode. So, in other words, this idea of escape velocity hasn't been achieved, and markets are worried that they won't be achieved because we see governments cutting back, and it's going to be very difficult for economies to stay strong and reach that self-reinforcing mode with the magnitude of cuts that are expected, along the lines of 1 or 2 percentage points in many economies on an annualized basis for GDP.
Okay, Tony, is it time then to flee into the safety of Treasuries? Is that where the smart money should be going, even though we have those 2-year Treasury yields pretty much at record lows at this point?
Well, it depends on one's equity exposure, equity-like exposure, and so forth. And because the correlations in periods like this between asset classes begins to rise very sharply. In other words, if one owns corporate bonds or gold or anything that's different than equities, will begin to act like equities when markets are falling down. I should strip out gold from that. It has momentum quality like Treasuries that increases as we see these correlations rise. So any investor that has this equity or equity-like exposure might consider Treasuries as insurance, in the sense that, remember, if we're in the midst of a storm and someone walked up to you and said, hey, your house is falling apart, but I'm going to offer you an insurance policy that's a little more expensive today than yesterday, probably in the midst of that storm, you'd say yes, because you're worried about losing your shirt, so to speak. And so it's in the same way that if you're in the midst of the storm, and the storm is the European debt crisis, the global sovereign debt dilemma, and of course the weak economies globally, the deleveraging in general, one might consider this insurance. And I should add, remember, look at the Treasury yield relative to the two things it should be judged against most in the long run, which is the policy rate, which the Federal Reserve in the latest week indicated will be staying low for longer, and of course the inflation rate, which we see heading downward from the 0.9% level for the CPI, 44-year low, to something lower. Could be 0.5% because inflation lags the business cycle by 2 years. So relative to those two key benchmarks, the Treasury yield is not unattractive, especially for those who have equity exposure or equity-like exposure. But of course, the broader range might be considered something like 3 to 4.25, 2 and 3/4, 4.25. Who knows? It just depends on the evolution of the data and the tightening of financial conditions that exist worldwide.
Yeah, 3 to 4% in this market environment sounds pretty good to investors these days. Tony, you talked about the storm that we're going through right now on the markets with the economy. As an investor, how do you make money here?
Well, when there's a low policy rate environment, there are several things that one could expect. It's just a steep yield curve, and that invites in a lot of different strategies. Technically, we would call them roll-down strategies. A 2-year note doesn't look particularly attractive recently when it was yielding 0.7, but when we consider the difference between a 2-year note and a 1-year maturity, which was recently at 0.3, that's a wide spread. Consider that 40 basis point spread does not exist between every other year in maturity. It doesn't exist between a 19-year maturity and a 20-year. So in other words, it'll roll down the curve. One can pick up yield that way. So it invites in the yield curve strategies. It invites in the idea that volatility in the interest rate markets will be kept lower, and so forth. And it also, lastly, invites in strategies on credit and currency selection. And we have to be more careful about country selection in this environment.
Yeah. That's exactly what I wanted to pick up on, Tony, about country selection, because as PIMCO mentioned in the past, maybe it's time to look away from these developed economies that are really rationing up their deficits to try to stimulate the economies. In fact, I think PIMCO is estimating that U.S. debt might soar to 90% of GDP. So should investors maybe be looking at more of these emerging market bond funds instead at this point?
Well, consider that the United States is a beneficiary of the global crisis because it is the reserve currency, in the same way that Germany within Europe is a beneficiary, and also Switzerland, which has seen massive capital flows. So there are big winners and losers, and on the capital flows front, it does seem that the U.S. will be able to continue fiscal profligacy for quite some time, at least until on a relative basis, there's some change in this situation, which it's not expected to be. In other words, China is not expected to become the reserve currency for a generation. The switches to other countries we would consider, for example, the Middle Eastern, North African countries. If you look 5 years out and look at a recent report by the IMF, you'd see that these countries are expected to have very favorable debt-to-GDP dynamics going forward, as would many countries such as Brazil, which has a high amount of reserve assets. And so countries like those, we want to stick with those who have, and think like bankers would, who have improving debt-to-income prospects and improving income prospects more generally.
Okay, Tony, thank you so much for your time. Tony Crescenzi of PIMCO. We're going to go to